Hey guys, what's happening? This is Matt Stevenson here. How you doing? Wanted to talk about a little known secret in the prop trading space. Most funded traders, so the people that pass the evaluations, lose their accounts in the first 30 days. And today we're breaking down exactly why that happens and how you can avoid it. So most traders who lose a funded account don't lose it because suddenly their strategy stopped working or they forgot how to read market structure. They lose it because of a massive mindset shift, which is natural. I've seen it happen to a lot of traders, happened to me when I started out. It's normal. Um, and it happens almost instantaneously the moment we pass and we get that email that says we're funded, right? Here's what it looks like. You get funded, you see the big account size, and something psychological changes. The capital feels less real because you have a cushion, the risk suddenly feels lower. Your strict position sizing starts to slip, or tends to. The predefined risk to reward ratios and the rules you followed to get here suddenly feel less urgent. And that leads directly to this spiral. One bad morning session, which happens to every trader, turns into a blown account. Why? Because you ignored your daily loss limit and you kept trading after you should have walked away. Revenge trading takes over and your account gets liquidated. I mean, guys, how many times have you heard the term revenge trading? It is a real, very real concept, and it's something. I mean, we shouldn't ignore that it is very real and that it can happen, and then we always need to watch out for it because it can happen to anybody and has happened to most of us. Look at the contrast here. You passed the evaluation because you traded with absolute discipline. You were the hunter, strict sizing, you respected the loss limit, you had your strategies honed in, no revenge trading. But once you get funded, you become the hunted. The discipline turns into arrogance, and you start treating your strict rules as mere suggestions. Look at these two screens. Technically, practically, there's no difference. The charts move exactly the same way. The only thing that changed is the number on the screen. But that was enough to completely sabotage your execution. Here's the reality check you need to hear. The evaluation and the funded account are the exact same test of your discipline. Remember that. The market doesn't care if you're on a trial or managing live capital. Think about it. The people that are on the other side of your trades, they don't care if you're in some test or they don't even know. And if they did, they wouldn't care. If you want to survive in this game, you need to understand the law of trading longevity. The traders who stay funded, the ones who the ones taking actual payouts consistently, are the ones who treat the funded account exactly like they treated day one of the evaluation. Same rules, same risk management discipline, same strategies, zero exceptions. Think of it like this. You have to pass the evaluation twice. You pass it the first time to acquire the capital and get funded. You have to pass it every single day after that to keep the capital and stay funded. Trading is mostly a mental game, and the longer you trade, the more you realize that. But I'm curious what trading psychological trap any of you might currently be stuck in. Comment a topic below, and I'll break it down in a full video. All right, traders, trade well, and see you next time.